Thank you so much, everyone, for joining us this evening for a webinar on GRIP's latest and greatest LoanX offering. I am also joined by my colleague Rishabh and our host for the evening, Rahul from SAVE. Rahul, I'll request you to turn on your camera if that's possible. Excellent. So again, welcome all, and thanks again for joining. We have a super interesting opportunity this evening to walk you through, and we will kick off with a quick introduction to what GRIP has been undertaking in the PTC SDI space. We'll follow that up with an introduction to SAVE, which is the NBFC that we have partnered with for this opportunity. And we'll follow that up with a quick recap on what LoanX is as a product, and then dive into the opportunity soon after. Rishabh, maybe if you can go to the first section. And actually, before I sort of kick off about GRIP, I would as I mentioned, Rishabh is just to introduce everyone on the call. Rishabh is a colleague, and he looks at new initiatives and credit. I'm the Chief Investment Officer for the platform for GRIP, and Rahul is the head of Treasury for SAVE. He's also incredibly involved in the strategy of the overall group. Maybe Rahul, I'll request you for a quick introduction to yourself, and then we can dive into the deck as well.
Yeah, hi everybody. This is Rahul. I head the Treasury for the SAVE Group. Of course, have about 20 years of experience in financial services, largely into NBFC and microfinance as a CFO. And today is a great opportunity given by Siddharth and Rishabh, and thanks to Grid team. We'll talk more about SAVE, and we'll discuss more about that. Thank you very much.
Great. Thank you so much, Rahul, for joining us. Quick recap on where GRIP stands today. And for those of you who attended our webinar with on another LoanX opportunity last week, will not find this new, but today GRIP is one of the largest alternative fixed income investment platforms for individual investors like ourselves. We have 3 SEBI licenses. We have touched almost 1,000 crores in investments, out of which half of them have been returns to our investors that truly demonstrate our impeccable track record. We have the support of more than 26,000 investors like yourselves. We were also the picture that you see on the right. We were the first ones to list a securitized debt instrument on a national stock exchange, which was truly path-breaking about a year and a half ago. And we are backed by a bunch of incredible venture capitalists and well-known fixed income investors. If you can go to the next page, please, Rishabh. Here's a quick recap on the 5 products that we offer, which are the 5 SDI products. They are all rated, listed, regulated, and secured. We have the LeaseX, which has been our perhaps our homestay product for the longest time, where we securitize operational lease receivables into rated listed instruments. We'll be talking today about a LoanX opportunity where, as you are aware, we securitize NBFC lease receivables and into a listed and rated product. We also offer NBFC bonds. We introduced BondX earlier last year, where we combined a bunch of bonds, a basket of bonds, and again securitized that into a single instrument, which was also the first for the industry. And we also have InvoiceX, where we securitize short-term trade receivables, loans against supply chain financing or trade receivables into a securitized single stream of paper. And of course, these are across the risk reward spectrum and rating. We have touched almost 250 CR in SDI products, of course, spread across leasing, LeaseX, LoanX, and InvoiceX. And LeaseX and InvoiceX, LeaseX and LoanX are almost neck to neck in terms of their split of what we bring to our investors. Also, more than 75% of our SDI opportunities are investment grade rated by all the top 3, 4 rating agencies. So we truly sort of believe in bringing the best deals for our investors that offer a very strong risk reward. So before we dive into LoanX and we speak about the opportunity a bit more in detail, I would love to introduce Save Financial Services to everyone. Save is the originator for, as I said, or a partner and originator for this particular transaction, this LoanX transaction. And I'll probably, maybe to put it I'll just sort of kick it off and then really request Rahul to talk a bit more about Save. But essentially, Save Group is a triple B rated entity that has an AUM of more than 2,000 crores. It's an amalgamation of 4 other NBFCs, which are in different lines of businesses. And they are backed by some incredible lending partners, investors, and are currently in their own journey of a very interesting equity fundraisers as well. But I'll request Rahul to sort of chime in and hear it from the horse's mouth, really.
All right, thank you. Thank you very much, Siddharth, Rishabh, and great team for creating this opportunity for us. So let me introduce the SAVE group of companies. So I represent a conglomerate, which is SAVE Group. We work in the space of financial inclusion. Journey started from 2009 and 10, and perhaps we are the most unique model in the country where we have a combination of assets and liabilities in the same group and not being a bank. So generally, we see that most of the NBFCs are there in asset space, and then we have business correspondents who are in the liability space. But we are a combination of that. So in essence, what started in 2009 and 10 by 3 promoters, Mr. Ajit, Mr. Pankaj, and Mr. Ajay Sinha, from a modest place in Bihar, to today we are the largest business correspondent company of State Bank of India. If you look at the journey in the last 15 years, we have grown from nowhere to today being one of the unique organizations who cater to about 2.5 crore families. So today's Save Solutions Private Limited, which is the parent company, which started its journey from 2009-10, works as a business correspondent to State Bank of India, Punjab National Bank, and a couple of other banks, with 15,000 customer service point outlets and touching about 2.5 crore families. That is our client base, and we are primarily into rural. So if you look at our outreach, we are present in more than 600 districts and about in 31 states. This journey, which started as liabilities in 2009-10, took a shape of assets in about 2017-18, when we took the first round of Series A investment from Incofin, and then we took a Series B round with Marge Invest in 2020, and quickly added rather asset side on to our liability strength. So to just give a brief of the group, so the parent company, Safe Solutions Private Limited, it is a liability business correspondent working with public sector banks, we provide about 40 odd services related to bank opening account, savings, money transfers, remittances, cash deposits, withdrawals, and so on and so forth. Then we have 4 subsidiaries. 3 of them have lending license. So one is Save Microfinance, another one is Save Financial Services. Then we have Save Housing, and then we have another asset BC company called Sagra Management Services. Together, our vision is to touch 5 crore customers in the next 5 years, and we are half the way through. We have already have a customer base of 2.5 crore. Um, to give you certain impact numbers, as I said, outreach is about 2.5 crore families on the liability side. On the asset side, we have a 2,000 crore book. Most of it is microfinance. So microfinance constitutes to about close to 1,700 crores, and the rest 300 crores is on rural housing and MSME. We have cumulative customer base of about 1.5 million on the asset side. As a group, we very actively engage in raising funds with various lenders. Today, we have about 70 lenders in the group, which includes public sector banks, private sector banks, small finance banks, NBFCs, and even offshore funds. So we do a host of structures. We do term loans, unsecured debentures, secured debentures. We do securitization through PTCs or DAs. So if they want to open an account, say is there, they want to send money to their to their son studying elsewhere, we are there. You want to receive money, we are there. You want a microfinance loan, yes, we are there. We want a house construction loan, we want an MSME loan, we are there. Even insurance is on cards. So that is the kind of vision we have as a group, and we are taking steps towards in that direction. And so
Okay.
that is in short what we are as a group.
No, that sounds incredible, Rahul. Thanks a lot for that quick introduction. Maybe I can kick off with a couple of questions. Could we actually go back to the group, and maybe Rishabh, I'll request you to go back to the earlier slide. Perhaps you can talk a little bit about Rahul, how the key numbers have evolved over the last few years, and so that would entail, of course, your sort of AUM, key P&L numbers, and at the group level, and then also if you could talk a little bit about Safe Financial Services as the originator. I think that would be really insightful. And how do you sort of see those going forward, and what's the plan?
Right. So as I mentioned earlier, the group primarily focused on liabilities from 2009 to 2016, 17, and that is when 17, 18 the asset side has started. So if we look at our journey for the last few years, so COVID was one of the event which kind of happened in 2021, and by then our asset book was very small. So we were largely on liabilities, but the asset took off post COVID from 2021. And in the last 3 years, cumulatively, we have lent almost 2,500 to 3,000 crores in the last 3 years in microfinance, in housing, and in safe financial services. So just talking about numbers, so we have, of course, the individual companies, subsidiaries, which are completely owned by the parent, having their own set of balance sheets and profitabilities. Let me just give you an overall picture at the group level. At the group level, we have a current net worth of close to 400 crores. That is the net worth of the group. We have the total borrowings at the group level. To just give you a rough math, is about 1,000 crores. So we're about 2.5 times leveraged on the total net worth that we have as a group. Again, these coming from various sources, from PSU banks to NBFCs to small finance banks. In terms of our profitability, so the NBFCs, of course, if you talk about microfinance, we are yielding, our lending rates are about 24-25%. So the microfinance typically makes about 2 to 3% profits, and it's profitable for the last few years. Coming to Save Housing was acquired into 2022, and post acquisition, the book has grown 3x. When we acquired it about in 2022, we were about close to about 50-60 crores. Now we're about 180 crores. The book is and Save Housing is also quite profitable with a capital adequacy of close to 50%. Then
Yeah.
we have Sagra Management Services, which is a pure play asset BC company, which is 1,000 crore AUM now. It has been in existence for 10 years. This is again acquired in 2022. So Sagra Management Services has been profitable for about 6, 7 years. COVID. We had a COVID impact. Again, the organization has become profitable. We expect to deliver strong profitability this year. It makes about 2% bottom line on the average asset. So this year we are expecting that Sagra would also make about 20-25 crores of profit. I'm talking about 25.
Got it.
Uh, the parent company obviously is a cash cow. It has been profitable. It has been a stellar performer from day one. We typically generate a commission of about 200 odd crores. That's what we did last year, and we make about 7-8% of it as a profit. Of course, we have certain investments that we have recently done, acquiring our office premises. Our head office is acquired, so there's certain depreciation which is coming and hitting us. So it's more of a accounting loss rather than really the 23 that we look at as a PAT is more of an accounting loss rather than a cash loss, because a lot of depreciation, about 10 to 15% of depreciation has come and hit us.
Got it.
And also the acquisitions that were made in 21 and 22, we had to take certain goodwill and write it off. So those were one-time impacts in 23.
Okay. No, I think that's super insightful. And I think, it's also provides a great, I think you just described the kind of product and the lender base that you have. I think it also provides a great segue, actually to the deal that we have for our users today. If we can, Rishabh, just scroll down, please. We do have a quick introduction on LoanX, but I think a lot of our users are very familiar with it. These, in a nutshell, it's securitizing these NBFC receivables in a rated, regulated paper, regulated both by RBI and SEBI because it's listed. So we'll sort of quickly jump on to the deal, and please do, feel free to ask any questions, of course, related to the product in the Q&A box. Rishabh, I'll request you to, spend the next sort of 10 minutes or so on running through the deal, and then we can dive into a Q&A.
Sure. Am I audible clearly?
Yes.
Perfect. Thanks. Hey, good evening, everyone. Let's deep dive right into the deal that we have on our hand. And we have a LoanX opportunity that is backed by loan against property. Rahul has explained in detail the product, the key product of the NBFC SAVE financial services, that is loan against product. And what we have is a deal which is backed by a pool of loans against property. So if we talk about the deal, this transaction is rated A by CARE and has a tenure of 48 months. The total deal size is 11 crore and it comes at a investor IRR of 13%. The deal comprise of 280 borrowers who have taken loans against property from SAVE Financial Services. It's a fairly granular pool comprising 280 loans, and the investment is getting amortized, it will be repaid on a monthly basis to investors. And you would see that it's at a slightly higher tenor as compared to our previous LoanX transaction, but this is naturally because LAP transactions are generally longer tenor transactions or longer tenor loans ranging between 3 to 10 years, right? But despite of that, because of how the deal is structured, the deal will be amortizing in approximately 48 months, right? With monthly amortization to investors. Now, let me talk about the security package which is available in the transaction. Apart from the security in form of loans against, so security in form of property, which is hypothecated in the transaction in form of loans to NBFC, right? So now the security cover entails over collateralization of 16%, which I would reiterate briefly what it actually means. So over collateralization means that if the loans in the transaction are, say, for ₹100, then investors are investing for 84 rupees in that 100 rupee pool. So always there is an extra buffer of cash flows which is available in the transaction. That is to the tune of 16% in this transaction. That is termed as over collateralization. Moving ahead, on top of it, we have a cash collateral of 5%, which essentially means there's a 5% FD lien in the transaction. Again, super liquid, always available in the transaction and can be utilized if required. On top of it, the third security component is excess interest spread. that is 55% in the transaction. And excess interest spread, I'll summarize again for our investors. Some of people might know, might not know. So excess interest spread is the extra stream of interest which is available in the transaction because the underlying loans are at a comparatively higher coupon, higher interest rate as compared to the interest which is being offered to investors. So therefore, the excess interest spread is there in the transaction, and a question might come that the excess interest spread is higher than the excess interest spread in our previous transaction. That is generally because this is a longer tenor transaction, and as if a transaction is a longer tenor, naturally the excess interest spread benefit will be higher, and it will be accumulating. So therefore,
Got it.
and yeah,
Sorry, Rishabh, thanks. I'll just add, actually, one of the things Rishabh mentioned earlier was that the return is 13%. I would like to reiterate, we do have the LEAP program ongoing at the moment for the transaction. And under the LEAP program, we're actually offering the transaction at a 13.3% IRR. The LEAP will close at 9 a.m. tomorrow. We've got a fabulous response over the last 36 hours. And yeah, we've just got a few more hours to go before the deal is launched on the platform with a reduced return for our users. Please continue, Rishabh.
sure. Thank you. Yeah. So now let me talk about why do we really like this opportunity and what makes it different from the opportunities that are available in the market, right? So essentially the way the transaction is structured is in a slightly distinct manner. First of all, the underlying is a pool of loans backed by property, as we have mentioned already, that these are loans against property. So fairly secure pool of loans. Then this transaction has a IRR of 13%. Of course, the LEAP investors, our early access program investors will get a 30 bips higher return through that. But yeah, so generally 13% is the target IRR in this transaction, which is higher than the corporate bond return, which is there in the transaction, which is available for the NBFC. And the third is the turbo par mechanism in the transaction, which essentially means that, and it's a very distinct feature, the excess interest spread, which generally flows back to the originator slash NBFC every month, right? That's how it generally happens. But in a turbo par mechanism, that flowback will not happen. And that interest will be used for the amortization of the investment. Or rather, I would say that that excess interest will be used for investor repayments. So that's what is termed as turbo par mechanism. Uh, Next thing is the pool. What's the underlying pool, right? So the investors, or sorry, the borrowers in the pool have a repayment track record of 13 months, which means that they have been paying loans EMIs on time since last 13 months. That's a weighted average seasoning. And the borrowers are these are good credit quality borrowers, which is reflective in the weighted average CIBIL of the pool, that is 748. Another important matrix is LTV and FOIR, which essentially means loan to value and fixed obligation to income ratio. These are very crucial matrices which are generally tracked in all mortgage-backed securities or mortgage-backed loans in the industry. So in the transaction, and LTV and FOIR are generally lower the better. So the transaction has a weighted average LTV of 27%, and the weighted average FOIR in the transaction is approximately 40%. Now, we have already spoken about the security components, but just to summarize that, so the weighted average security cover in the transaction is approximately 1.5x, and owing to the way the transaction is structured, the 25% of the defaults in the pool will be covered owing to the security available in the transaction. In other words, the investors will not be impacted at all if the default reaches 25%. So that's a summary of why we like the transaction. Moving ahead, I think this is again a very generic slide, but just to summarize quickly, as and when the investments amortizes as the tenor passes, naturally the security cover keeps on increasing, and therefore you would see that in the 13th quarter, the security cover, which is 25% as a starting date, at an initial pool, will become 100% of the investment amount at 13th quarter. And as it amortizes further, the security cover will increase multifolds. Yeah, now let me quickly talk about what exactly LAP loans are and how these are distinct from the other unsecured and personal loans for which LoanX are also available, right? So LAP loans are loans against property, and what makes this different from personal loans are these are generally longer tenor loans, and therefore you would see that the tenor of this transaction is also higher. And yeah, and the tenor of this deal is 48 months. However, the weighted average balance tenor of the pool is 68 months. Again, as I mentioned earlier, because of how the transaction is structured, the transaction will amortize earlier because the interest will be used for early amortization. Yeah, and the security cover, I think we've already spoken about it, but just to reiterate that apart from the available weighted average credit enhancement of 1.49x, there is an inherent security cover in form of property collateral because the underlyings are LAP loans. So therefore, there's a dual security cover available in the transaction. Yeah, now just quickly moving ahead to how the underlying pool of loans look like. The loans are spread across 7 states, like Bihar, UP, Haryana, etc. And further that these are further diversified within 21 cities. The weighted average CIBIL score of the borrowers is 748, and just to I would like to mention that these are latest CIBIL score. These are not dated CIBIL score. These are latest CIBIL scores, and the cutoff CIBIL score is 675. There are no loans in the pool, rather no borrowers in the pool have a CIBIL of less than 675. So that's a cutoff CIBIL score. And the average ticket size of the loans in the pool is INR 451,000, and weighted average repayment track record is 13 months in the pool. Again, we've already spoken about the loan to value ratio. 27% is the weighted average loan to value in the pool, and the weighted average fixed obligation to income ratio is 40%. Yeah, again, very interesting point. 97% of borrowers in the pool have taken loans for their residential property, and only 3% of the loans in the pool are against commercial property. So again, since these are residential mortgages, so sentiments are also involved with the borrowers, so therefore, comparatively lesser risk. Yeah, 70% are self-occupied properties and 31% are vacant plots. Yeah. So just to move ahead, we've also summarized.
Sorry, Rishabh, I would just add on the vacant plots,
Sure.
just for clarity of our users, these are plots where these borrowers are at the moment, constructing their home for self-occupancy. So these are not plots that are necessarily, just not being utilized or as second homes, but they are going to provide primary homes for several of these borrowers in the pool.
Yeah, these will be converted into dwelling units. Yeah, construction is absolutely right. Okay. So yeah, so I was saying that we have summarized here how our transaction compares to the very recent transaction PTC slash SDA transaction done by SAVE. So just to cover this quickly, so the credit rating of this transaction is a notch higher than the credit rating of the preceding transaction. This is KRA as compared to KRA minus of the preceding transaction. Pool amortization, which is seasoning, is largely same. Yeah, moving ahead, the weighted average, or rather the borrowers having a CIBIL score of more than 725 is 81% in the pool as compared to 43% in the preceding transaction. Weighted average LTV and FOIR are also marginally lower in this deal, which is again a good thing. Security cover at issuance is higher, which is again a good thing as compared to the preceding transaction. EIS is largely in the similar range, 50 to 55%. Expected tenor is also in the similar range of 45 to 48 months. But yeah, interestingly, the IRR at which this deal is being offered is again at a marginally higher return for investors, despite of being a comparatively safer, rather less riskier transaction. So that's an interesting piece. Yeah, so I think most people might be aware about the waterfall mechanism, pretty straightforward. Just to summarize, the distinct feature is that the interest will also be utilized, the excess interest will also be utilized for the repayments to investors, and also if just one more thing, if the cash collateral is dipped into during any time in the transaction, it has to be replenished by the originator so that the security cover remains intact. Yeah.
Okay.
Yeah, that's it. Yeah.
And I'll take maybe Rahul, I'll put you on the hot seat and ask you the first and the foremost question about the originator that talks about why it has been in loss for the last couple of years. You did allude to this a little bit earlier, and you also spoke about COVID. You also spoke about some depreciation. But if you can cover that to begin with, that would be great.
Yeah, sure. So when you say originator, so we have two things here. One is, of course, it's a group, and
Yeah.
second is Safe Financial Services.
Yeah, we're talking about
So
safe
as
financial services.
Yeah, Safe Financial. So Safe Financial Services started lending only in 1920. So relatively, if you look at when we started lending, immediately COVID hit us. So there is a COVID impact that we had to take initially. Now this happened in other group companies also. It happened to Safe Financial Services also. Now, because of that, we had to make certain provisions. And then the post-COVID book, if you look at from say 21, 22, if we take a cutoff of January 1st, 22 to say March 31st, 24. In the last 2 years and 3 months, we have lent more than 115 crores. And there the NPA is about just 1%. This is again a cumulative number for 3 years. I mean, if I break it down to say annual, it would just about say 0.3, 0.4% or less than 0.5%. Now, every organization, especially in financial services companies, in lending and in SME, typically break even once they cross about 200 to 150 crores. We are yet to reach there. So we would expect break even to happen this financial year when our average asset would be somewhere around 150, 170, 180. So we are expecting break even this year. Coupled with one more thing is that equity infusion is going to happen in Safe Financial Services. So Safe Financial Services already has a capital adequacy about 35-40%. Further capital is getting infused in Safe Financial Services. In the current year, we're looking at 25 to 30 crores of additional equity coming in. So two ways it will help. One, it will help us to reduce the cost of funds, I would say the interest expense rather. Number two, when the scale builds up, operationally we will break even. So the reasons for the loss primarily are two. One is COVID. I will summarize. The second is the scale itself. So typically MSME companies would break even once they cross about 200 crores. And that is when you get better ratings and you're able to attract funds at a lower at a lower cost, so on and so forth. So we are at the initial stage of a life cycle, but we are backed by the parent, which is profitable and which is a strong net worth. And as we are talking, we are doing a round of equity, and the equity is expected to go from about 300 right now to 375. Is expected to cross 500 by end of the year. So that is the reason why we're in loss, and hopefully this year our math is saying that we will make a profit for FY 24-25.
Okay. Great. Thanks for covering that. I would just add to that and remind our users that unlike NCD transactions, in PEC, while there is a reliance on the borrowers to reliance on the originator to make collections, there is these transactions are they have no recourse to the NBFC, or these are bankruptcy remote, so to say. So I mean, there is I think, while of course Save's own growth is incredibly important, and I think, but what we took a lot of comfort from was their ability to collect, that they have demonstrated in the last 1.5 to 2 years that Rahul alluded to. And while he spoke about the NPA numbers, I would also add that their collections have been close to hovering around 90% over the last few quarters. So I think those are some of the real sort of operational metrics that have given us some good comfort. I think the next question I would say is, Rahul, again, back to you. How will Save handle loan foreclosures?
Right. So of course, I mean, foreclosures are part of our business. So people, I mean, although our loans are about 10 years, what we have seen in our experience is that on an average, loans do not last beyond say 6 years or 7 years. Typically, the customer would come back and close the loan, foreclose the loan, or they would like to take, like to switch if for better interest rates. So whenever there's a foreclosure, obviously the foreclosure proceeds are taken. There are foreclosure charges, so the charges have to be paid, and we close the loan. So whenever there's a foreclosure, we will also pass on that cash flows to the trustee and to the subscribers. Along with, of course, there is a foreclosure charges, which are typically charges which we incur as expense, we reimburse. But the foreclosure, whatever foreclosure amounts come, of course, that is passed on to the subscriber, and the loans are closed.
Okay. Yeah. No, thanks, Rahul. And I would also again just add that, foreclosures are, I mean, they don't happen overnight. They are a 12-month, 18-month process. Having said that, our focus in the pool has been really selecting borrowers that have a really good CIBIL, have low loan to values for their properties, have low fixed obligations to their income ratios, and also a pool that's incredibly granular. So I think, while it's definitely important to keep in mind how the foreclosures would take place, and how much time they would entail, with the kind of pool that we have, and with the security package, the 16% OC, the 5% CC, which is the maximum permissible security package from by RBI. I think we feel that our pool is very well secured, and the payments should happen to all our investors on time. One of the questions is, will the EIS flow to the investors towards prepayment? It is stated so in the credit rating document. Absolutely. The EIS, because Rishabh explained earlier that this is the turbo pass structure, in which case all the collections in the pool will be used towards either repayment towards the instrument, or the interest payouts, 100% of the collections. The next question is, how does GRIP choose these loan pools? Are there any basic safeguards? Maybe, Rishabh, do you want to take that quickly?
Sure, can take that quickly. So we follow a very exhaustive approach and detailed approach while filtering the pool. So we take a total RBI eligible pool from the originator, and we slice it and dice it. We analyze the available pool in all manner. We make sure that the pool is RBI compliant. Then we compare it then we slice and dice it in all manner. We compare it with the portfolio performance of the company, and make sure the filtered pool is diversified enough, and the borrowers in the filtered pool are of good credit quality, and it is in line with the overall portfolio performance of the company. So we therefore, basis that, we arrive at few filtering criteria, and basis those criteria we filter an ideal pool for the transaction, which is diversified and granular enough for the transaction.
Okay. Thanks. Thanks, Rishabh. One of the questions back to you, Rahul, would be, or even Ajiji could take it. How does Save handle non-payment of loans? We did talk about foreclosures earlier, but on an ongoing basis, maybe you can talk a little bit about your collection team. How do they nudge investors? They send them borrowers. They send them reminders. If you can talk a little bit about that, please.
Ajiji, would you like to take that question? Would you like to take that question in terms of collections, and how do we, what is our collection strategy? What kind of collection team we have, and how we have sent notices and reminders to customers, especially when the loans turn bad? What is it that we do? Would you like to take that question?
Yeah. As I said, we have very good presence in as per as CSP, as a CSP. and we have a separate collection team. And now I would like to say here, we have started our journey in 2005 as a recovery agent, empanel recovery agent from State Bank of India. We know very well how to recover the amount, how to collect the amount, and we are also eligible for implement the surface in the surface because after cross the 100 crore, as per as government gazetization, we can implement surface to the default borrower. We have very good mechanism. We have legal team. We have a legal team. We have good mechanism, and we have CSP. Sometimes we take help from the CSP. This is you belong from this village, and you can please go and ask for the repayment loan. So I mean, research must say we have good presence and we have good mechanism to collect the amount and recover the EMI.
Got it.
Yeah, just
Okay.
to adding to what Ajit is saying. So basically, we have the first thing we do is that we send reminders much before the payment date. So we send out messages to the customers that your NASH is going to hit, and then please kindly maintain the balance. Wherein the NASH bounces because of technical reasons or for any other reasons, we immediately get into the field. We have a collection team. So each relationship manager or the is mapped to about. We have 190 people, out of which 150 are relationship managers who are on the field managing this 2000 customers. So each of them is mapped to about 20 customers. So they would go reach out to the customer, recover the money and deposit that in about few days time. So just in case if we're not able to recover it, so and it turns bad, say for example 90 days, 120 days, as Ajit said, we have SARFAESI license, and SARFAESI Act really allows us to quicken the process. We have already initiated a few cases which pertaining back to 21, 22. We are seeing a lot of traction on that. We are hopeful that in the next quarter we're going to we will recover quite a bit there. So we have a strong collection focus as a group also. Our recovery rates are generally higher in terms of when I compare, say, microfinance or MSME or housing. Our collection rates are slightly better than the industry averages.
Okay, great. Thanks, Rahul. Back to one of the questions on the tenure, and the question is: so if there are any defaults in the pool, will that mean that the tenure increases beyond 48 months? I think that's a great question. So our base case underwriting assumes a certain collection deficiency, which could be due to operational reasons or any other reasons, and also a base case default rate. This base case default rate is, essentially over a period of 48 months, the pool can default up to 15 to 16%. And even then, our investors will get paid out within 48 months. Just to put things in perspective, Rahul mentioned the default rate of 1 to 2% earlier in the webinar. So this is an incredibly high bar of default rate to be breached. This is, really, I mean, we want to be very sure about the transaction coming to a close in 48 months. This default rate also results in a collection efficiency of about 80 to 83%, as against nearly 90% that the SAVE has at the moment. So again, this 48 months tenure is incredibly defensible, and if anything, we expect it to be a bit shorter than that. But this is the base case that we are going with. I'll move on to a couple of other questions. One of the questions is with respect to the investment opportunity, does the prepayment of home loan impact the IRR? No, that's not the case. The prepayment of home loan essentially means that money will be available for payout of investors' principal and interest sooner in the transaction. And so, while the prepayments could result in the shortening of tenure, but expected tenure, but it wouldn't impact the IRR that the investor expects at all. One of the other questions around turbo par is whether this structure offers better protection to the investors. Not necessarily. There are different deals. I mean, typically in longer tenure deals with the home loans or LAPs, turbo par is one of the features that's often implemented. Otherwise, both turbo par or par offer, depending on the transaction, equally good security in the transaction. What turbo par does mean again is that you will get paid out sooner if with whatever collections that are in the pool. We already spoke about, there's another question around how we choose loan pools, and I think we have sort of already covered that in one of the other questions. I think one of the other questions here that we're seeing is, are these lending LAP in lines with similar to banks? Are property getting marked as mortgage to lend against? Also, in worst case scenario, at what point investors loses money? So maybe I can, I'll quickly mention a couple of lines here, and then I'll ask Rahul to chime in. But these properties are, or essentially, SAVE is creating equitable mortgages. So these are registered equitable mortgages. Banks also follow largely the same practice. And whether in worst case, when do the investors lose money? Look, I think one of the slides we showed, and Rishabh covered it. I think the default in the pool has to be, I think, Rishabh, 27%. Do I remember that number correctly?
25%.
25%, my bad. So it has to be 25%, which is over and above the base case sort of default or delay that we have already assumed of 15%. So this 25% is in excess of that, and that's when the investors will not get their returns on time. They still don't lose money, but that's when they'll not get their expected returns on time. And so I think there's a huge buffer in actually the investors losing their money, and again that comes from excess interest spread, over collateralization, cash collateral in the transaction. One of the other questions is, will the EIS flow to the investors towards prepayment? We've already covered that. The answer is yes. One of our users, Rishabh, wants to know what's our better understanding of the pie chart of the state-wise allocation. If you can please go to that pie chart. And maybe, Rishabh, if you can just explain this pie chart, the one on the top left corner.
Sure. Yeah, absolutely. So this pie chart essentially reflects how the underlying pool is spread across different states. So the loans are across 7 states in which the company is operating. 50% of the loans pertain to Bihar. 30% of the loans, rather the borrowers of 30% of the loans are in UP. 5% are in Haryana and 5% in Jharkhand. And just to one more factual information, that the Bihar is post-COVID, Bihar was the state which recovered very, very fast as compared to the other states. Just a general factual information, but yeah, Bihar is the 50% maximum exposure. Apart from it, these are further diversified within 21 cities, which is not reflecting over here that what are the cities and all. But within these 7 states, these loans are across 21 cities across these 7 states. So yeah, that's what it essentially means.
Yeah, so just to add to what Rishabh's point is that we are very strong in Bihar. We have very, very strong network of our CSP points there. So our strength is immensely there in Bihar. So you will see that Bihar, we are more Bihar dominated because that is where our origins are. And we were very confident in terms of recovery. Even if we have to invoke security, we are very confident there. So that is the reason why you will see that most of it is in Bihar. But of course, we are diversifying. About 2 years back, this was 80% Bihar. Now it is about 50% Bihar. I think going forward, you will see more and more states. So now it is about 7 states that we are operating in.
Okay, great. I think with this, we are a few minutes past our scheduled time, and we are also done with answering actually all the questions. Having said that, I would definitely urge our investors to do check out the deal on the platform. If you have any questions, please feel free to reach out to your respective RMs, and we'll ensure we get to the answers as soon as possible. Once again, I would like to thank Rahul and Ajiji for their time, and it was a pleasure bringing this opportunity along with you to our investors. And thanks, Rishabh, for your insights on the transaction. This was fantastic. have a good evening, and we look forward to speaking with you on another webinar very soon. Bye.
Bye.
Thank you,
Thanks
everybody.
everyone for
Thank you,
joining
Thank
in.
you,
Lakshmi.
thank you,
so
thank
much.
you, everyone.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer related documents carefully.